Moving ahead with the next session, which is on growth, scale, and exist. In the last 5 years, India has seen startups get their place in the sun as scaled and thriving businesses that are driving growth and innovation in the economy. Let's delve into the factors that have contributed to this success, both at business level as well as macro and market level. Let's welcome our moderator, Preeti Singh, reporter, Bloomberg LP. Preeti is the finance reporter for Bloomberg in India and writes about the financial services sector, wealth and private equity. Previously, she's worked with the Wall Street Journal in New York, where she covered institutional investors and private equity. Can we please have a round of applause for Preeti? We would like to welcome our panelists, Mr. Kawaljeet Singh, founder and managing partner of Fireside Ventures, with a career spanning more than 3 decades in the consumer brand and investing ecosystem. Kawal brings deep expertise in venture investing, strategy and business development, brand building and marketing. As the founder and managing partner of Fireside Ventures, he has successfully raised 3 separate funds with several notable investors and nurtured several of the largest homegrown consumer brands. Up next, we would like to invite Paula Mariwala, founder partner, Aerolis Ventures, co-founder, president, Emeritus, Stanford Angels, India. Can we please have a round of applause for her? She is a physicist, technologist, investor, and mentor. Paula brings over 25 years of experience shaping India's entrepreneurial ecosystem. A Stanford alumna, she was at the forefront of Indian venture capital before startups became cool, leading early-stage investments in transformative sectors like technology, sustainability, social impact, and women empowerment. Last but not the least, we would like to welcome Mr. Pawan Chaturvedi, partner and head Asia Unilever Ventures, an experienced finance professional and qualified chartered accountant. Pawan established Unilever Ventures direct investing arm in Asia. Based in Mumbai, he's responsible for leading investments across the region with focus on beauty, personal care and wellness, consumer tech and enterprise tech. Can we please give them all a huge round of applause? So without any further ado, I request the moderator to please take the lead and proceed further.
Thank you. I'm so excited to do this panel. And the previous panel really puts this in perspective. I know there's a lot of geopolitical tension, but private equity and venture in India have been thriving and growing. And so our topic is really growth and exits. And I will talk to you guys about that. But just very briefly, seeing that this is a room full of women, I'm going to just flip my last question and ask you guys to quickly tell me how you think about gender diversity in your teams as well as in your portfolio companies.
Thanks, Preeti. Pleasure to be here, specifically because it's a Women in PE Forum, something that really is close to our hearts at Fireside, certainly for me. In terms of how we think about diversity, actually, the real fact is that as consumer investors, 95% of decisions in a consuming household are made by the women. So it's not a surprise that not only are the consumers we are targeting through our brands are women, we invest actively in women founders. 45% of our founders are women. And in our team, again, it'll be silly to say that we do all of this and we don't have enough women in the team. So overall, as a team, 45%, actually 50% of our team members are women. So for us, it's not even about diversity, it's about necessity. And we truly believe that that's been one of the big reasons for our success, is because that's the focus for us.
Thanks, and thanks for kicking off with this question. I mean, obviously, gender diversity is very close to my heart because I've been at the other end. When we started a VC fund about 20 years ago, we were already 2 partners, Bharti and myself, who were women, but we had such few women coming to us as founders. We were always on panels as the token women because there were such few women in the VCP world. I think, the reason it is important is equal voices need to be heard for rationality, for bringing different perspectives, and for giving equal footing. I think the number of women founders who are able to raise as much as men is still, it's warped. The ratio is not good. So it's exceedingly important that we support women founders. One of the ways to do it is through making sure that women investors grow, bring in funds from women LPs as well. There are very, very few women LPs. We talk about women investment managers, but we see very few women LPs as well. So to Kamal's point, I mean, women are equal stakeholders. They make a lot of decisions, whether it's consumer, whether it's many services, health, education, and the large things that the PE forum members, the PE investors talked about. We will not have, really the right kind of companies coming unless we change this at all levels. For me personally, it's been a huge issue, and I continue to support and give voice to women in our sector as well as to women founders.
I think for us, I think just seconding whatever Kamal you said and Paula you said, right? Our focus areas are, beauty, health, wellness, nutrition. And as Kamal said, that 95% of the decisions are taken by women. Closer home, we are a global fund, right? So we've got our offices in London and Mumbai. And we've got a team of 10 investing members, out of which 6 are women. Even closer home in India, I've got a diverse team. And the reason why we are able to make some really good investments is because we've got this diversity, right, of views, gender, everything. So we really believe in this, and it's something which we've not, it's not designed, it just happened. I think we've got some great team members. As far as founders are concerned, again, really balanced. Almost 50% of our companies would have women founders. So yeah, so I think looks easy, at least with 3 of us.
Great. That's really great to know. So just now to come back to the topic, where are you guys seeing growth coming from? I mean, in terms of sectors, in terms of regions, and to add to that, where are you really? How has your funnel expanded in the last couple of years? Maybe we start with you, Pawan.
Sure. I think the kind of sectors which we are investing in, there's massive tailwind and massive headroom for growth, right? So if I look at sectors like beauty, health, wellness, which is where we are really focused on, right? If you think about India's per capita income 2018, about $1,500, now $2,500, and the kind of massive, growths which we've seen in the kind of startups we've invested in is just unimaginable, right? And we are not talking of the per capita income moving from $2,500 to $7,000, meaning more discretionary income in the hands of consumers, which means a lot of these sectors will see a lot more consumption, right? So we are seeing massive tailwinds. I think one big thing which has happened over the last couple of years and will intensify is the amount of competition. So you see a number of international brands coming in. The choice in front of consumers is massive. So you really need to do a damn good job, right, to really shine amongst this really tough competition, which probably was not there till about 2020, 21. So massive opportunity, but at the same time, huge competition. And in terms of regions, right, if I look at my portfolio, I'm seeing founders from Jaipur, from Thane, Raipur, Bombay, Bangalore, of course, even Calcutta. So it's coming from all regions, very smart entrepreneurs. And I think the funnel has really, really widened. I think the other thing which has happened, right, between 2018 to 2023, we saw a lot of masstige brands coming up. Now, because of the point I made around per capita income increasing, etc., we're seeing an influx of a lot of premium brands, a lot more aspirational categories like fragrance, etc. So we are really excited.
Sure. I mean, I think the India consumption story is rolling out very well. In terms of regions, I think it's going beyond the metros, even tier 2s to tier 3, and indeed even to the last mile, with e-commerce reaching in various models to smaller towns, even to rural India. Besides, of course, the consumption story, which, they're both more experience to talk about, and it really is a very good story. I think what I look at as an early stage fund are sectors which are actually, or models which are now becoming sectors. If you look at, for example, digital transformation across traditional industries, let's take manufacturing. I think there is so much scope for innovation there, and you can get scale quite easily even if you focus only on India. There are companies like Zetworks, Karkhana, Simplify. I mean, a lot of them have taken a route which was not a VC fundable route earlier. So I think applying technology, indeed AI is part of it, to traditional sectors and really help them scale, improve efficiencies and so on. It may not look very sexy, but it's a huge opportunity. Even if you touch agriculture, renewables, we may call it climate tech or whatever, but these are sectors which are ready for innovation, for adoption of technologies, adoption of new models, and adding efficiencies. Space is another sector. I've invested in a couple of them. We are hearing a lot of that. Drones. So these are technology companies, but with very Bharat applications. I think that's another opportunity that I'm excited about, which can scale, whether it's in India or globally.
Sure. Like Pawan said, we are investors in the consumption story. And I think the way I would characterize it slightly differently is that, at the macro level, there is going to be another $1.5 trillion, $2 trillion of consumption added to the economy in the next 5-7 years. I think that's a fact. Nobody can challenge, that there is going to be growth in the overall GDP of the country, whether it's $1.5 trillion, $2 trillion, just for consumption. So that is one of the macro fact for us. I think where the growth is coming from is very exciting. I think there is a structural change in how consumption is happening in the country. We have seen mainstream companies. I have worked with Unilever, Pawan represents Unilever, and so many other large players. There is a very large, mass market, middle class, which was the core of everything. I think that is getting disrupted. And it's getting disrupted on 4 different counts, if I may. There is a very clear cohort of consumers who are emerging, who are looking for different choices. So in the same home, in the same closet, in the same wardrobe, you will see brands representing different parts of the household. So what used to be millennial, urban, digital, which is when we started, is today become much more complex in terms of consumers, in terms of channel, in terms of geography, in terms of sectors. So, we were doing our math last week for our annual conference, and we said we were targeting $1 billion of opportunity when we started, and that number today, if you just expand this horizon, is $750 billion. So I would say that the opportunity is endless. It's really being more thoughtful, being more focused on how do you build sustainable brands, how do you not get almost enamored by this whole concept of just giving discounts and buying sales, because it's not only competition, it's also consumer who's becoming smarter and more demanding. So opportunity is never an issue for us. It's really about how do you thoughtfully build brands around that is becoming more interesting.
So I'll come to brand building in a minute. And I know that 2 of you actually are single LP driven funds, and you have a bunch of LPs. How are you sort of, the venture industry's changed in the last 2-3 years, because you have to look at a path to profitability. How has that sort of gotten baked into investment decisions that you're making, and how you're thinking about the growth of your brands or the investments that you make? Because surely that's undergone a radical change in the last 2-3 years as well.
Sure. So I think the underlying principle has always been unit economics and enough opportunity or headroom to grow for a brand which is competing in spaces which we call white spaces. So if the space is available, if there is a very coherent story to build a brand in that space, and you're doing it thoughtfully with the right unit economics, we think hundreds, if not thousands, of brands can be built in the country, and we have seen that even in the last 8-10 years. So from our own point of view, how do you take a company which is doing, let's say, 5-10 crores of revenue annually to that 50 crore, to then 200 and 500? There is a playbook, there is a method to this whole, approach of building brands in a certain manner. What channel choices, how do you do your NPD, how do you plan your media spends, how do you build the brand? So obviously, I'm not doing a crash course in brand building here, but I think the learning for us has been that there is a way to do this in a repeatable and authentic manner, brand after brand after brand. And that then, plays into how we perform, that plays into more predictable success, that plays into LPs wanting to work with us because there is a certain path to the thing. I think what the panelists before us talked about is this whole concept of, cash returns or TPI is becoming more and more, critical than just the, mark-to-market growths. And that plays into the hand in a lot of our categories because that is how these businesses get built. These are not high spend, high capital, upfront businesses. So in a way, I think we are privileged to be in a market where these possibilities exist, where you can create not only great brands, you can also create great business models, which will then return capital.
I think profitability is an outcome, right? But what goes into our investment decision-making processes, we are looking for founders who are like paranoid about product. Because let's be clear, right? For startups, resources are limited. What they need to win on is the product. Beyond a point, you won't have the marketing monies to spend. And if you start into, that spending a lot of money on marketing without focusing on product, you will never get repeats. You don't get repeats and you've got a leaking bucket, and unit economics is an outcome, right? So I think for us, investing behind founders who are paranoid about product is filter number one. I think the filter number two, which we look for is in today's world, is founders who are really digitally native, right? Because that helps in communication, marketing, distribution, right? Because we are seeing brands becoming 500, 600 crores just on the back of digital distribution. So that's super critical. And I think third bit is people who know how to craft brands, right? That's equally important as well. So those are three filters which go behind our decision making. And we believe that if we do this well, then the outcome would definitely, over a period of time, be building brands which are sustainable, profitable. Because all said and done, right, when you're investing behind a company, at times we've come across companies who've started small, been bootstrapped, and they've not raised capital for years. And that's a great validation about the founder, about the company. But at the same time, you'll have companies who started and raised capital, might burn for a time. So I think those three filters become super critical for us before we identify companies we invest in. And that really helps.
I think one of the things about scale, particularly in a D2C kind of a market, is to isolate scale and unit economics. Because you're always, like you said, you have a leaky bucket and you can scale, you can spend money. In the end, does the actual model work? So we often ask, if this is the last check you will get, can you show me what you will do? Tomorrow, like 2008 happened, or so many things, you never know what Trump will announce tomorrow. I think the mentality of the founder to be loyal to the idea and the product, and to be focused on the customer, rather than just on getting, the marketing is great, you build the brand, but the brand has to be solid. The brand must have, the consumer, solve a real problem for the consumer loyalty then grows, and so on. I think a lot of founders want it very early on. It just takes time, and scale will take time, and that will eventually, of course, lead to exits for investors like us.
Right. Now, everyone's really talking about the consumption story, but you're also seeing, news that consumption has slowed down. You're also seeing the stock market correct itself. And I wonder how that's really getting, baked into your investment decisions. Have valuations become reasonable enough in your patch of the world? How are you thinking about that? And at the same time, how is that really impacting the exits that you were planning? Because I know it's been a fantastic time for exits in the last 18 months. So how are both of those things playing for you? Any one of you can take that first.
So I think firstly, I think all of us said, right, great macro story. And we as venture investors, we got a much longer horizon, right? So you could have those periods where the markets are not great, the consumption is slowly died down, but the long macro story is bullish. So I think that's fairly clear. We are not investing on short-term trends, right? We are looking at long macro trends. So which is where I think investing is easy to say that we will invest, right? And we'll be long-term on India. I think in terms of your question on valuations, etc., of course, I think we've always been disciplined. I know Fireside really, really well. So Kamal has been very disciplined from the very beginning. It's very important to get in at the right valuation because at times, your returns get determined by that, right? So I think we've been disciplined, but yes, the current environment definitely helps. Uh, what had also started to happen was a number of tech funds had got into consumer investing in that period, right? Now what has happened is people are now focusing on their core areas, which makes life simpler for funds like ours and Fireside. So I think that has happened, but as I said, the long-term story still bullish, not too much worried about these short-term deviations. And the kind of sectors which we are investing in, and I'm sure you're reading about it, the premiumization is still on. So we are not seeing any kind of slowdown there. If at all, growths have increased and a lot more money coming into India because everybody wants to come to India, international companies, brands. There are very few markets, right, outside of the US. It's India and of course there's China. So we continue to remain excited. Of course, be cautious on the entry valuations, and the current environment has definitely helped us.
And how's that sort of, how are you thinking about exits in that environment then?
Yeah. So see, I think good companies will get an exit, honestly, right? Whatever be the environment. So I think focus on building good companies. At times in a not so great environment, you might have to delay your exit by a year or 2, 6 months out. But if the company is good and you are confident, I think even in today's market, right, you could IPO a good company. Because if you see what's happened currently, right, a lot of stocks were inflated and the corrections have happened on the basis of results which have come off, where either the revenue growths have died down or the profitability has come down, right, and then the markets have taken a beating. So I think if the fundamentals of the business are good, you don't really have to worry on exits.
As a very early stage investor, I think the funnel has changed. So the funnel of founders wanting really high valuations for projections which were based on irrational growth, I think that is sort of filtered out. So, to start with in the early stage ecosystem, that is definitely a correction in the valuation expectation. Where I think we have to be cautious is some of our companies, when they go for Series A, B, C, the valuations are dropping. So there are down rounds which will happen, which are happening. So as early stage investors, we have to be pragmatic and support the companies. The growth has slowed in consumption, for example, it has slowed. I think what we were expecting was maybe irrational in terms of growth. Particularly in sectors like EdTech, we were just expecting it to be very, very high. I think corrections have happened, so it's a more realistic growth. If we put that, and Kamal can probably give examples of some of his brands which have seen this, they've gone, given exits, they've gone IPO, and then there's been a slowdown. The point is that the long-term consumption story is there. For exits in any of the sectors, whether it's brands, D2C or any others, I think you have to believe that that sector is not going to collapse. And many sectors are growing. The India story, the Bharat story is growing. When we did a seed fund and we had, Kamal was part of it, exit in Redbus back then, it felt like it was too early. We were not used to exits at all, so we just took when we got it. I still believe exits have to be timed and one shouldn't wait for the final hurrah. But in the current context, as early investors particularly, I think we should look for exits when a company is doing well. Take some money off the table. IPOs will happen. They're increasing the pace at which they're happening. But I think still away from really betting on exits happening at the time when you want it.
Paula, I just want to take a minute. I know that you also invest in EdTech. There's been a lot of negative stories around EdTech, though I know that Physics Wallah's just filed for a DHRP for an IPO. How are you seeing the sector, and how's that thinking changed?
You see, EdTech has been a complex sector to start with because it sort of borders on profits, not for profit, and so on. I think the whole wave during COVID, and even before it started, the technology creeping into education. Education was forgotten. It was only getting the consumer. But what you are delivering and what is expected as a result, it was sort of sidelined. It was too much about the number of people who have bought your program. We forget that there is a parallel, there is a real industry or the real sector which is delivering education. There is a real world out there which is employing these people. So again, I think we had lost the plot in what is the outcome that we are delivering. Valuation was the only game in town. I'm not saying they did not have good products. Many of them did, and they still do. I think the hype around saying this is the only way to get an outcome in a complex thing like education, which is, you know, as much of a socio-economic thing as a financial thing. I think that was absolutely misled. Investors are very responsible for giving this kind of hyped valuations, and that the model will completely bypass what is true education. I think that was a big, big mistake. I think in health and education, one has to really understand the existing ecosystem as well.
Yeah, Kamal, sorry.
Back to exits.
Yes.
So actually, I want to lay out a slightly different perspective than what Pawan said. I think we believe in a concept of exitability, and therefore, very early on, even when we are starting out the journey with the company, we start thinking about what could be the kind of exits that are possible. And then as the company builds out, there is an active discussion within the team and with the company saying, is this all in, go big or go home? Or is this a potential for engineering an exit in a way that is a win-win for the founders and for the funds? And that discussion actually becomes very early in the journey of that company rather than waiting for some big outcome to happen. We have a full-time person on our team who's 20 plus years in iBanking, who's been tasked to keep this perspective alive, and we have partner level intervention of saying as a portfolio how are we thinking about exit. So there is a institutionalization or a method to the madness. Now companies that I think what Pala also mentioned is which are looking like they could be really big winners, then we design them in such a way that we keep taking money off the table in smaller chunks and keep returning money to the investors, because I think everybody will acknowledge that unless you return money back to investors today, all the markups are not really worth more than the paper they're on. But the more interesting thing is companies which have hit that 100 crore, 150 crore mark are showing good unit economics, are either profitable or near profitable. You have to design to plan for their exit at the right point of time. And both secondaries to other PE and to strategics are becoming very viable options for that. So I would say that exit is a very big part of our job. All of us here are mostly private equity people or VCs. Is thinking of exit and planning for it as a portfolio over a period of time, to me, is critically important. And I have seen in my 20 years journey plus that we didn't do a good job of that many times in my past life. And that has been one of my learnings, saying, listen, be sensitive to what is your investor looking for. And very often the founders are very open to those conversations. It's just that we haven't had those conversations with them. So the fact that we had a yoga bar exiting to an ITC, we could structure a deal, the company is doing really well, they're going to get great value, and there is a way to a path to exit, is a very honest conversation to have with the founder. So I would say that planning for an exit to me is an ongoing exercise in the life of every fund.
Got it. Just like brands are disrupting, I think the larger traditional brands, I think the other thing that's really disrupted distribution is all omni-channels and now really quick commerce. And I'd quickly like each one of you to really weigh in on that in terms of how you think about the growth of your brands and these various omni-channels, including quick commerce.
I think mainly let's touch upon quick commerce, right? I think what quick commerce has done is it's a great surrogate for GT, or let's say offline distribution, right? Because you like it or not, young brands, when they try and go offline, they go through multiple layers of distribution, unlike a large traditional company, right? Where I sell to a distributor and it goes to a wholesaler, retailer, or a retailer directly, right? Unfortunately, because of the size, you end up working with a super stockist, sub-stockist, right, wholesaler, and then it reaches to the retailer. Now, what happens is a result of it, and if you've gone in offline a little too early, you realize your mistake quite late, right? A lot of damage has been done, and there are brands who got decimated on the back of going offline a little too early because the cost of mistake there is really high. Now, think about quick commerce, right? Quick commerce model is based on going into multiple cities, multiple pin codes, dark stores, and so on. So in a way, you are going to those pin codes, but you're going via quick commerce. The call as a brand you need to take is, even in quick commerce, do I want to go into so many dark stores from the very beginning or not? Or do I take my calls? I go to a couple of cities, a few pin codes, right? Because there as well, if stock doesn't sell, it will come back to you, right? So I think quick commerce that way has been really good for the brands. One, it's a surrogate for offline retail distribution. Second, it has increased the pie of overall e-commerce, right? So a lot of companies, for them, quick commerce has become really, really dominant. Companies which were 5 years out, it's become large, but maybe not the most dominant channel. Companies who've been born over the last 2, 3 years, for them probably it's the most dominant channel, right? So I think being omni-channel is supremely important. Also realizing when to go offline is equally important as well, right? If you've not got success on beauty retailers, if you've not got success on an Amazon, now on a quick commerce, it means that maybe your consumers are still don't know you, they still don't, they connect with you, and hence going in offline could be disastrous. So I think omni-channel strategy is super, super critical, and I think quick commerce has been a big addition to it, right? It's really helping the brands in a big way. I think one of the companies we exited, Minimalist, right? And they're almost 500 crores plus. Their offline contribution is really less, right? Less than 5% or maybe 5 odd percent, which means you can build really nice businesses and then, use all those learnings, insights and go offline, and then your chances of success are a lot higher. I think that's what all digital distribution is about.
How much time do I have?
About a minute.
So, quick commerce, and I'll talk a little bit more about the broader Omni thing as well, actually has done a few things even bigger and over and beyond, like what Pawan was saying. It is a great way for extending the whole journey of the brand in the area of, how do you get to consumers and how do you build great franchise without having to go offline so early. But I think what quick commerce has done is two things. One is it has brought in the very strong discipline back to saying, I need to build my brand, and performance marketing alone is not going to be my savior. And I personally, as a marketer in my past life, and every brand, believer in this world, it is a fantastic, new opportunity, because there is no way that you will be looking for discovery on quick commerce. People will go to quick commerce to buy a brand and not to look for, what is the best sourdough bread that I can buy. They want to go in, they want to buy Baker's Dozen, they want to buy Slurp Farm, and Sweet Karam coffee, etc. So that is one phenomenally powerful, I would say, almost like a, strong, back to basics thing that has happened. Second thing that has happened with quick commerce is that it has opened up markets which were not e-commerce able. So things like snacks, things like 10 rupee pack beverages, so things like ice creams, chocolates. These were not e-commerce products. So actually there is a new market that is opening up for digital first brands which did not exist. And we have companies who have seen the benefit of that, like Pawan was mentioning. And lastly, the most important thing is that quick commerce is not e-commerce. So people who have been very successful in e-commerce and don't understand the nuances of quick commerce will not succeed there. So there is a new playbook, there is a new opportunity. So I would say that people have talked about profitability in quick commerce. I think it's a more profitable channel in the long run than even e-commerce. Now coming to omni-channel, I think where technology has played a big role, and a lot of our companies are seeing, company like Sleep Company, Numi, Okera now, that you can actually create a customer journey which is omni-channel in a true sense of the word, if you are able to bring in the right level of technology, personalization, CRM, etc. And that again is a game changer. Today, Sleep Company, one of our mattress brands, is doing phenomenally well because they are able to discover online, buy in the stores, go back online to engage with the brand. And they have been able to very seamlessly manage both front end and back end in a very almost like, uninterrupted way. So therefore, for a consumer, it's not as if I am an offline consumer or an online consumer. I am a Sleep Company consumer. So Omni is actually even more exciting if you can build it as a customer-facing, seamless experience, and not just multiple channels in terms of your conceptual way of thinking.
I just want to add to what Kawal said, but before that, let me just say my biggest, what is called anti-portfolio is Zepto, because he actually, Adit pitched to me the very first, Manish may remember, because he was admitted to Stanford and he had this idea and he said, who's going to buy quick, I mean, who needs 5 minutes? We can always get things. So, you know, one always misses. It was, I think, beginning of e-commerce was like that. But I think what is really brought, quick commerce, what it has really brought is bridge this omni-channel gap. I think one other opportunity besides the brands is, for the brands is, you know, with omni-channel you have the opportunity as a consumer to connect with the, to have a dialogue with the brand online, to understand nuances, to ask questions, and then you can go feel and buy. And the data that, like Kamal said, I have invested in a couple of companies which use the data that you get from online. And then they are creating so many tools for the brands and for the consumers to improve experiences on both ends, to improve productivity and so on. So again, digitization of traditional businesses using all these data and omnichannel again gives a really good opportunity. But in quick commerce, look at this Insta-Maids that has come up. So services are also going to become part of this quick commerce. So I think we are at the stage that we were, I think in 2010 when, you know, e-commerce had just started. And again, anti-portfolio Flipkart, we said at Seed Fund, we said no, because who needs to buy books online? So I think we will come up with a lot more models around this as well.
So which really brings me to what I am very excited about is I want each one of you to tell me one investment that you're really proud of and one investment that you wish you had made and you didn't. And I'm mindful that we're running over time, but I just want to make sure that we have that.
Well, I already said Zepto. And
Zepto's the one you didn't invest in.
Yeah. An investment I'm really proud of is one called Brainsight, which two women founders, and they're making a digital map of the brain, which will create tools for better diagnosis for various brain-related diseases and so on. And they've been very frugal. They've only raised, I think, 7 to 8 million so far, and have got good traction. And it's a tough business, but they've really put in a lot of good stuff around it. So I'm very proud of that.
So, since the question is which I'm very proud of, I will not say the obvious Mamaearth and Boat and others. There's a company called Rosanna, which we have invested in. This is a rural commerce company, essentially empowering women in villages to become their partners and then providing them with you know, a whole range of you know, products, supplies. I think it'll be a very successful, it'll be a fantastically large business, but just the fact that the impact they are creating and just the ability to, you know, work with grassroots women and truly empower them, that's really what makes me very proud. Companies that I wish I had invested in, there's so many, but one that I personally feel I completely missed out, it was my call not to do it, and you know, I have always regretted it, is a company called Atomberg. We saw them even before they, you know, got into the market, and there were some concerns about distribution and how do you build a consumer appliance business by, you know, started by two IITians technologists. And, you know, it's truly a regret that, you know, we should have done something with that.
I think for me, we started our direct investing practice in 2019, right? So the first couple of investments, which we made up pretty close to my heart, touch wood, they've done reasonably well. I think one is Plum and the other one is Minimalist. I think they've built some beautiful brands and great founders, and I'm sure they'll leave behind a legacy as to how brands should get built. So yeah, I'm quite proud of both of them. And then of course, you know, there are a bunch of other companies as well. In terms of, you know, miss outs, you know, we got a chance to invest in Zepto, which we thought was at a valuation which was pretty high, but now it looks cheap. I think the other one has to be Nykaa, right? I would have loved to be part of Nykaa, learn so much about that platform because, you know, we invest a lot in that area. So I would say these two companies would have been great to be part of.
I want to make sure that I have 2 minutes to open the audio, any questions from the audience. Okay, so I guess they are nervous about not asking you any questions. So let me let me just wrap up with some last thoughts on what really worries you about the current environment.
So I think the uncertainty is certainly not a good, obviously, option for any of us, and therefore, there is an issue of geopolitics. The previous panel talked in detail about global investors and what that implication has. All of us have to keep raising funds. I mean, maybe not these two, but certainly several of us sitting in this room. So I think the uncertainty is much more around some of these global trends. Fortunately, the isolation of consumption in India is still to our advantage, and I won't repeat the same point. But to an extent, the global geopolitics worries us, but not to the extent of sleepless nights, fortunately.
I think very similar to what Kanwal said, and I think the other thing is global uncertainty at times doesn't impact us, but impacts a number of, let's say, global organizations who could be potential acquirers of our companies, right? So when they go through a tough time, M&A comes to a halt, it impacts exit. So yeah, so I think global uncertainty and the impact it has not just on the Indian companies, but also global companies who could be potential acquirers, those are the two big risks.
Yeah, I mean, echoing, the same, but I would just like to add that, I mean, if funds dry up in terms of LP movement in India, then the company's growth, even though we may not have to raise funds, but the companies have to raise funds. So the funds are being very cautious now. So, the next rounds are becoming difficult, which will slow the growth of those companies, which will slow the exit and so on. So it's a classic cycle, I think, that we are in. So I wouldn't say it's a very big risk, but it's a risk that we are used to. We get these cycles. The point is, when you get out of it, one still has to remain rational. I think that's what I worry about. We've seen many times we come out of these cycles with more irrationality. And let's hope we come out of this with more rationality and continue the growth. I think the growth story is there.
Great, and thank you so much, Pawan, Paula, and Kanwal. I've had a great time moderating this panel. I hope you enjoyed it too. Thank you.
I request our panelists to please stay back. And without any further ado, very quickly, I would like to call upon Mr. Manish Khetarpal, co-founder and managing partner, Waterbridge Ventures, to present the giveaway as a token of appreciation. We also humbly request all of you for a picture to capture these beautiful moments in the memory lane. Ladies and gentlemen, I hope all of you are having fun with the game. Thank you, Nukebox Studios, for making this game for us. Can we please give them all a huge round of applause? Thank you very much. So requesting you also to please join in.